Good morning, sub-tours. Welcome to this episode of Goat Talk. Goat Talk is our Facebook Live that we do every Thursday morning. This is our final edition from Portland, man. Jody and I are going to blow this pop stand on Monday and head down the California coast. So the next one will be from, I guess, California. Gosh, we're still over there. Couple of things this morning, guys. We're at the end of 2021, so think about what you want to do different next year. You know, are you going to make a change? We've been looking at real estate investing for a while and just haven't done anything with it. I'd like to invite you to join us in our premium coaching group, Sub2 Max. You can check it out at sub2max.com. We have a lot of fun in there. And you'll learn some stuff too. So also, if you haven't yet, if you're watching us on YouTube or maybe you're on Facebook, but subscribe to us over on YouTube. And they want to ask you a bunch of questions to identify yourself when you're talking to us and all that stuff. So, and share the live stream with another investor that you know. This morning, we've got a great guest here. If you guys have been following us for any period of time, he's no stranger to you. Tax expert, entity expert, trust expert, gosh, master of all he surveys. Oh, yeah. Is that, what is it, Pilot Coffee this morning?
No, not this morning.
Not this morning?
Okay. Not this morning.
But Mr. Bill Walston. Bill, welcome to Go Talk.
Thanks, buddy. Appreciate it. Love being here.
We're going to bring Bill on to talk about all things tax related. If you've got a question, give us those in the chat box or whatever that thing's called. Hey, Phil, good to see you. Cindy from down there in Jackson, Mississippi area. Sarah, good to see you. Boy, she's bragging on Bill. She's always thankful when Bill is on. He has so much knowledge. How much did you pay?
I started to say, check is in the mail there.
Okay, guys, today we're going to talk about the top 5 things that you can do to decrease your tax bill next year. So Bill's going to run through that. We're going to take your questions as we go. We've got a slightly abbreviated version of Goat Talk today. Bill is a busy guy. He has got another appointment at the end of the hour. So we're going to do 45 minutes today. If you got your questions, you better drop them in. Bill, introduce yourself to everybody.
Thanks, buddy. I think, fortunately, we run in the same circles. So probably most everybody here knows me. But for those who don't, not only am I a real estate investor, but I'm also a certified public accountant. I don't practice now. I only do tax strategy. I don't prepare tax returns. I got out of that like 4 decades ago and am very happy to stay out of it. But I love doing the tax strategy, just like I like putting together creative finance deals. You know, it's kind of like a game to see what type of strategies you can kind of cook up and stay within the tax laws and rules and regs. It was like the other day I saw a post that said something to the effect that billionaires should not be able to decide when they pay their taxes. I don't know if any of you guys saw that or not. I said, hell's bells, they don't decide. The tax code does.
That's right.
You just got to know the tax code or know someone who knows the tax code like me, who can explain it to you and help guide you through those things, because taxes are a game. And you just got to learn how to play learn the rules and put them in your favor. So today we're going to talk about some last minute tax strategies. And believe you me, it is last minute because this is now December 30th.
That's right.
But some of these things I'm going to talk about today, you can actually carry over into the new year. It's not so much as spending right now and having to get a last minute tax strategy implemented by buying something, but it's going back and looking at what you did last year and making sure it's classified properly and that you're using it to your best advantage, right?
Right.
So the first thing that you need to get to know is that, as far as I'm concerned, it all begins with what I call the trifecta, right? I used to call it a 3-legged stool type thing. It's a way that we set up our business structure, right? And our investing structure and our personal structure. And it's like, if you imagine, if you would, a line drawn down the center of a page and you got 2 sides, the left side, the right side. The left side is what we call the active side or our operation side. This is where wholesalers would be working, where W-2 jobs are, those types of things. Then you have the passive side on the other side, That's where you have your rental income and your investment assets. And they all funnel down to either you as an individual, or what I'm really working with my clients on this year, a living trust, right? For asset protection and anonymity. Okay. So looking at the left-hand side, this is going to be important for you wholesalers. Remember, that is active income, right? So you want to protect that if you can from self-employment tax, because active income is subject to self-employment tax. So if you are a wholesaler and you're making net more than $50,000 a year, your butt ought to be in an S corp, right? Having an S corporation, because that's going to save you self-employment tax. That's 15.3% on every dollar. And so we look at it and say, well, how does that affect me right now? Well, if you just started an LLC and it's an LLC that is a sole proprietorship, you can go back and reclassify that LLC as an S corp, okay, and save on that tax return. So that's one of the first things that you want to take a look at. And even going into next year, okay, talking about saving taxes for next year, maybe you can't elect an S corp status for this year, but you can elect one for next year. And you need to do that relatively quickly, because if you're going into the next year with a LLC that needs to be taxed as an S corp, you've got until March 15th to make that election. So you need to be talking to your tax pro about that. But guys, if you are $50,000 or more net, you need to consider using an S corporation for your wholesale deals. And I know, William, even though we do sub 2, right? That's our gig.
That's
there are
right.
some people out there who actually do wholesale. I don't know why. I've not figured out yet why they like that as a strategy, but some people do.
Wholesale is a lot of work. I've always thought it was just a
all
lot
those
of work.
people who really want to be only as good as their last deal.
That's right. Yeah. We got a lot of people jumping on here. Hey, JC Nichols, good to see you. Mike, good to see you. Michelle, Don Shoemaker says 2 of my favorite goats.
Oh, cool.
Hey, Don, we appreciate you. Cindy's got a question. And listen, we invite our Sub 2 Max students in. We actually give them a link to join us in StreamYard. We've got a few in the green room right now. Guys, turn your camera on and we'll bring you in to ask your question. Cindy's got a question here. Is there any benefit to paying my 2021 rental property taxes before the end of the year, or just wait until January?
Oh yeah, there's definitely a benefit. You pay them this year and you deduct them this year. So if you're needing a tax deduction, right, then go ahead and pay those. Go ahead and pay
There you go. There you go, Cindy. You better get out of the courthouse.
Yep.
Get those, you only got another day or two.
Now, the only thing with that, it depends too on how that's set up. Because remember, if that's a rental property, that's passive income side. Okay. So if you do not need the tax deduction, if you've got a lot of depreciation and stuff like that, and you don't need the tax deduction, I don't recommend paying them early, right? Because remember, passive losses, you've got a $25,000 max loss that you can take, right? So if paying the taxes early are not going to benefit you, then you may want to wait and conserve your cash flow, right? Conserve your cash. But if you're on the active side, and guys, here's the thing, but a lot of people don't realize, if you're doing short-term rentals, if you're doing Airbnb, okay, you have active income. You have active income. A lot of people get surprised by that. And when they have to pay that self-employment tax, that stuff like that on their active income, their Airbnb stuff in the year, they pitch fit because they didn't realize how it's going to be taxed. Okay, so if you've got Airbnb income, you might need to be looking for some of those tax deductions. And so it would be good to go ahead and pay it now.
I know Cindy had a couple. I think she still do. Cindy had some Airstream trailers, I think, that she.
Oh, did you really? How cool is that?
Yeah, I know, really. Okay, guys, if you have any questions, hey, Jeff, good to see you. If you have any questions, let us have those. Nick, Andrew, I see you guys in the green room. You turn your camera on, we'll bring you on. Okay, so what's the next thing they can do?
Okay, so another thing that people need to be looking at and calculating at the end of the year, they sometimes overlook, is the home office. I know there are a lot of accountants out there who say, oh, no, don't take the home office. That's a red flag. That'll get you audited. That's complete BS. Okay. There are ways that you can take that. In fact, if you do, like I'd suggested, and you do a S corporation, it's kind of hidden, classified into office expenses and stuff like that. You don't see home office expense listed on your tax return. It's included with the utilities. It's included with office rent. It's included with those types of items. So S corporation is a good way to do that. Now, if you're a sole proprietor or partnership, you can still do that. So if you haven't been doing it, you need to go back and you need to take a look at all your utilities, lawn maintenance, anything that you paid for your house. Okay. And you can take a percentage of that as a deduction on your tax return. If you're filing a Schedule C, you will not be paying yourself any money. You'll just put those extra expenses onto your Schedule C on your tax return to get a benefit for that. So it'll decrease that net operating income, but you'll also decrease your self-employment tax. Okay? If you are a S Corp, this is what I love. You do it through what we call an accountable plan. Don Shoemaker knows exactly what that is because we set one up with him this past year. Okay. You set up an accountable plan. You can actually write a check from your corporation to you as an individual as a reimbursement for all these expenses. It is considered a deduction for the corporation, but it is not taxable to you as an individual. So it's really, really a nice tax break that you can get there. Again, it's not something that you have to worry about paying for this particular year. You can go through and you can allocate those for next year or do it during next year and have them recorded on your books for your December year end.
Right. Hey, Randy, good to see you. Now, Bill, before we came on today, you told me that you had a little surprise for 6 lucky people here today.
Oh, yeah.
But they have to participate now.
They do have to participate. They have to be asking questions in here because Jody's going to tell me who participated in this live. Okay. So do not sit back and be a quiet little church mouse and not participate and then expect to get one of these.
That's right.
So you need to participate. What I'm going to do, I've made room for 6 tax strategy sessions going into the new year. We'll be holding them in January. Hopefully the first couple of weeks. They may stretch out to the end of January. Doesn't matter. We'll get them done. But it'll be a tax strategy session where I'll give you some ideas of some things that you can deduct, some things that you can be looking for. Okay. The way you get one of those is to write me at bill@billwalston.com and either the subject line or the first sentence, just say, I'm in, give me a session. Okay. And then we'll go through and we'll choose 6 people out of those.
Okay. Sounds good. Okay. So they're waking up now. Okay.
They're going to participate now. Good deal.
Good to see you this morning. Jeff has a question. He said, should I have different LLCs taxed differently for active income versus long-term buy and hold?
Oh, absolutely. Yep. Because they would be, if you're still imagining that T-bar, right, that left side, right side, your active income will be over on the left-hand side. Your passive long-term rental property is going to be over on the right-hand side, right? And the old adage, William, you've probably heard this before. We used to say a LLC taxed as a partnership to hold, an LLC taxed as a S corp to flip, right?
Right.
And that still holds true. Most accountants will agree with that. And that's why they say you need one type of entity for your flips and the other type for your holds.
Okay. Kevin asked a question. What was he just saying we need to set up? You were talking about that situation you set up with Don. I can't remember what you called it.
Oh, it's called, all right. So if it's a corporation, okay, or a partnership, you need to set up what is called an accountable plan, ACCOUNTABLE, accountable plan.
And Kevin, if you ask a tax question while you're on here, you'll have a chance for a tax session with Bill, and you can ask him all about it.
Oh, Kevin knows that people from Elizabethton don't pay taxes.
Is that right?
Yeah, that's the inside joke. He'll get that.
Okay, Cindy says, Mississippi girl for the win. Pick me. Okay.
All right, send me an email, Cindy.
You're in there. Michelle asked, do you also prepare and file an LLC and individual tax returns?
Okay, I do not prepare tax returns. I do tax strategy.
Mhm.
Okay, so it's, somebody said, well, it's getting everything ready for the tax return so you can just turn it over to whoever puts your info on the return itself, right?
Mhm.
And for any of you guys who do not have an accountant, just check with me. I got a guy I work with. He's excellent. We're on the same page on these types of deductions and stuff, and I can give you a referral.
Okay, well, there you go. Hey, we've got one of our Sub-2 Max students on camera here. I don't know. Kevin, did you want to ask a question this morning? You're out patrolling the streets
Kevin, how you doing, buddy?
of Seattle. No? We can't hear you.
We can't hear Kevin.
Yeah, we can't hear Kevin. So, Kevin, get your mic working and come in here and ask us a question. All right, buddy.
Whatever it was funny.
you have a good day out there. Kevin's riding around with a goat this morning. Good for you, buddy. All right, let's see. We've got Phil Smith in here. If I'm purchasing property Sub-2 and selling with contract for deed in my main LLC, should I transfer them to a separate LLC when I get a few with a decent amount of equity? I'll tell you where that comes from. That comes from what I tell these guys, and that is that how many properties should be in an LLC? And I say, for me, that's risk factor. It's if your LLC gets sued, what can they get? If you put 50 properties in an LLC and you got $3 million in equity, and that LLC gets sued, you can lose $3 million.
Right. So, and that was key. What you just said. I usually go by equity, right? I usually go by equity. And so if I feel like $200,000 worth of equity, $500,000 worth of equity is within my comfort zone for risk, then if I've got 10 properties with $50,000 worth of equity in it, I'll have 10 properties, right? If that's my comfort zone. If I've got one property with $500,000 worth of equity and $500,000 of equity is my risk factor, then I will have one property in the LLC. So I am not one who says, oh, you got to have an LLC for each individual property. That's a pain in the butt.
Oh, okay. Listen, I got into an exchange. It's been a while back now with a lady in a Facebook group about how you set up a separate trust and a separate bank account for every property. And I said, you're busy, aren't you? I said, man, that is crazy.
William, what I will do, what I will do is I will have, I take my properties in a trust. Okay. So if I'm taking a property in a trust, then I will make the LLC the beneficiary because that's where your asset protection comes from. Because a trust, guys, believe me, a trust does not give you asset protection. Okay. The asset protection comes from having the LLC as the beneficiary. Okay. I have an LLC set up on the right side, right? My asset side. I have an LLC that acts as nothing but a beneficiary for my trusts. And you can have multiple trusts, all with different names, all with different trustees, right? And they can, and the LLC can be the beneficiary of those. That is a phenomenal asset protection device because who's going to go looking for that? The nice thing about a trust is anonymity, right? Because if they don't know you own it, they ain't going to come after it.
That's right.
Okay. So guys, if you're not already taking property in trust, that's what you ought to be doing. You should be taking your properties in trust, even if you sell those properties later.
Go, you guys go and listen to our podcast that I did with Bill on land trust. It's a lot of information. It's good. We should do another one just on some, we
can do that.
More content. We can do it.
I got to sign up for those anyway. Okay. One other quick tip that I'll throw in here before we take another question. Dining. Okay. Guys, don't forget that in the last year, where entertainment or food used to be 50% deductible, it's 100% deductible now if it's in a restaurant. Okay, 100% deductible for 2021 and 2022. So be thinking about that when you have all these Christmas dinners. Get you taking people out. Take your board of advisors out. Now, if your board of advisors happens to be your spouse or your family or something like that, still deductible as long as you're talking about some business. Okay. Any entertainment, any clients that you take out, if you take them to a restaurant, that's 100% deductible now. And you do not have to keep all the receipts. You just need to write down where you went, who you were with, okay, and what you discussed, and just keep it on a calendar.
Okay. Well, there you go. Gosh, get these questions. Michelle, I need a setup. I need to set up an accountable plan. Is it an involved process?
No, it's not. They're very easy to set up. Very easy to set up. And Michelle, if you ask for one of those strategy sessions and you get it, I can tell you during that strategy session exactly what you need to do to set one up.
Well, there you go, Michelle. Good luck to you on winning that.
I help my clients with those.
Yeah. Farouk says, Bill, I know you've covered this before, but can you remind me, please, if member distributions count as income when doing my accounting?
Okay, member distributions do not count as income. Okay, the income, depending on how your LLC is structured, how it's set up, the income is determined by the profit and the loss from the LLC. Distributions, you can go, I mean, you own the LLC, so you can write cash to yourself anytime you want to. That is not the income. The income is determined by the P&L statement. Okay, by the income statement, whether you're an S corporation or whether you are a LLC taxed as a sole proprietorship, taxed as a partnership. It's the income statement that determines the total income for the entity, and then the setup will determine how it's allocated on your tax return. Distributions are not income.
There you go.
To you as the individual.
Okay. Phil says, sounds like I need a tax strategy session with Bill. Well, it sounds like you do.
Yep. And
Don,
Phil, you need to check your email, buddy, because you wrote me and I responded to you about that.
Don says Bill's tax strategies have saved my LLC and S Corp major money the past 2 years. He is the GOAT of tax strategies. Well, there you go. Facebook user, if you want to be eligible for the drawings for the tax strategies, we need for you to go to StreamYard.com/Facebook. Let us know who you are. I'm getting a check from one of my companies that I own with a partner. The check could be made out to me or my other company. I was thinking having it made out to me personally so I can contribute to my Roth. I know I would have to pay taxes if I took it personally. Any other reasons not to take it personally?
Well, here's the thing. There's not enough information right there for me to tell you, but I can give you a couple of options. If it's a distribution from a membership, that you are a member in a partnership or you are a member in a S corporation, it's not taxable if you take it personally. Okay, I just answered that question a minute ago. Distributions are not taxable income. It depends on how that entity is structured and what comes to you in the form of your K-1 that is taxable. Okay. I don't think you need to have it made out to another company, because another company can't take a distribution from something it doesn't own. Okay, so if that company you own with a partner, you own that membership in your name, you need to take that distribution personally, not into another company. Now, you can take it and receive it and contribute it to another company if you want to, as some type of capital or something like that. But a company should not give a distribution to another company unless that other company is a member, if that makes sense.
Okay. All right. Next question. Do home office deductions apply if you still work a W-2 job?
Oh, absolutely does. If you are, let's say you have a rental real estate, right? You own rental real estate. You've got to have an office to sit down and work out the books or analyze properties or something like that. So you absolutely can have a home office even if you have a W-2 job.
Mm-hmm. Okay. Farouk has another question. When I buy a sub-2 and sell on contract for deed in my S Corp LLC, but then after a few months of sitting on it on the market, I end up renting it or doing a lease option, can I assign it to my holding LLC?
Well, first thing, you should not buy sub-2 in an S corp. If you're planning on holding that property, never, ever, ever take title to property in a corporate name. Now, should you have a corporation for active business? Yes, you should. But that corporation should not own real estate, even if it's an active company. All right. Somebody says, well, if I wholesale, don't I own the real estate? Yes, but you're buying and you're immediately selling. You are not holding real property in that corporation, even in the S corporation. Okay. Anything that you're going to buy and hold should be taken in either a trust with an LLC beneficiary or in an LLC that is taxed as a partnership or a sole proprietorship. Never, ever take title to property in an S corp.
Yeah, it's hard to get it out, isn't it?
It absolutely is, because you have all kinds of bad tax consequences when you try to get it out.
Yeah.
Okay. Now, the exception to that rule, believe it or not, okay, and I know this sounds kind of crazy. The exception to that rule is, let's say you have a personal residence and you decide to buy a second personal residence, and you're going to convert that first personal residence that you had, your previous residence, to a rental. Okay. Did you know that you could sell that property to an S corp that you own, get stepped up basis, and exclude the capital gain? That is when you might want to take title to a property in an S corp, but that is the only time, and that's a kind of an advanced tax strategy that I use with some of my clients. Okay, but it's really, really great to bump up that basis for additional depreciation, right, on the rental property, and to also exclude any gain on that property, so you don't lose that $250,000 or that $500,000 capital gains exclusion.
Okay. Cindy has comment. Love hearing these two giant Southern voices, and you know it, Cindy. Man,
right? You can move the boys around, but you can't get rid of the accents.
That's right. Jeff said, more interviews on land trust. I'm still lost when it comes to how to set them up. Jeff
needs to set up a call.
Yep, Jeff needs to set up a call.
With either one of us, because we both do that.
That's true, Jeff. We need to talk about land trust. We need to do a call on that for sure. Kevin says, I have a management and consulting LLC I funnel all cash through. I buy and sell everything using trust. So are you saying I should do another LLC as a beneficiary?
It depends. All right. And it depends on your structure. You can use, no, I wouldn't even go that far. Yeah. You need two separate LLCs. You need an active LLC. You need a passive LLC. Your passive LLC should be the beneficiary of your trusts. And when I say these are for properties that you're going to hold, rental properties, not properties that you're going to sell. Now, if you have a management and a consulting LLC, that's an active LLC. Okay. And if you're making more than $50,000 in that LLC, it should be an LLC taxed as an S corp.
Okay. All right. Jeff's got a question. I think we've covered this a couple of times. What is an accountable plan? Jeff, why don't you put that question in the Max group? Don's in there, and I'm sure Don would be willing to do a little bit of explaining on what that is, since he's got one. So throw that question over there.
He uses it very, very well.
Okay, so there you go, Don. I'm
actually, I should say the lovely Pam uses it very.
Oh,
very
is that
well.
right? Yeah. Well,
I digress.
There you go. Kevin, I need one of these sessions. What do I need to do? Email Bill. That's Bill.
We already said it. Bill at billwalston.com, and just say, I'd like a strategy session, and 5 people will get one.
Yep. Is it 5 people? Okay. I think I gave away an extra one. Is it 6? Okay. We're going to get 6. Randy.
He twisted my arm. It's usually 5, but he twisted my arm. I'm leaving early, so somebody gets an extra.
That's right. I beat him up before we got going here. Randy says, how much time do you have to spend on your real estate business to be deemed a real estate professional?
Oh, Lordy. It has to be at least 750 hours, but it has to be more hours as a real estate professional than anything else. Okay. So if you everybody says, oh yeah, you can do it. It's so easy to do. That's crap. Okay. If you work a W-2 job, it is almost impossible to be classified as a real estate professional because you would have to work more hours in your real estate business than the hours at your W-2 job. And that usually just doesn't happen.
Okay. Farouk says, that's actually what I do. I buy in a trust and my active LLC is a beneficiary. Good for you. For his sub-2 acquisitions, that is. Okay. We got Vincent. Hey, Vincent. Good to see you, man. We're coming through your part of the country soon, so we want to try to get together with a bunch of you guys and have lunch or dinner. Did Congress make any changes to 1031s this year?
Nope. Congress, as usual, hasn't done a damn thing. Now, I will say the House has passed that Build Back Better bill. Okay. It's hung up in the Senate right now. And that's the one, incidentally, I'll take one step back. Even that bill did nothing to 1031 exchanges. It did make some dramatic changes to retirement plans. Okay. But it has passed the House. It has not passed the Senate. Thank God for Joe Manchin. Right? Because he's the Democrat that is holding that up right now, and the bill has not passed. So they've got some time to still debate on it and still time to make some changes on it. But even that bill, if it does pass, it doesn't contain anything about 1031 exchanges.
Okay. Andrew has a question. Now, Andrew, you can come into the studio if you'd like and ask it on camera if you have another one. What structure do you appreciate for projects involving partners who invest in flip type properties?
Okay. All right, guys, remember I told you that you needed to have an active LLC taxed as an S corporation if you're making over the $50,000. What I suggest to my clients is that they as individuals do not act as partners with other people in flips. You have your S corporation act as partners in those other flips, if that makes sense.
There you go.
And development projects, Andrew, I would never, ever do a development project that was not run through as an S corp.
Okay. Vincent says, what are your thoughts on LLCs in California? As you know, each LLC.
Oh my God, LLCs.
I wouldn't even be buying anything.
You have to pay $800 to exist in California.
Right.
If you need to have a California LLC, I suggest that you just bite the bullet and you have to. Yeah.
If you're having to buy that many of them, you're making plenty of money anyway.
Yeah. So. Now, here's the thing, Andrew. A lot of this is where William and I would say this is a good reason not to have multiple LLCs. Okay. Because if you know what you're doing, you can run your structures, have the active LLC, the passive LLC. Okay. You can do that without having to pay but the one filing fee on the active side. Okay. You can even at some point, you may want to consider on the asset holding side is just use a regular partnership. LLC gives better protection, but sometimes you don't want to run into that extra filing fee and stuff. So you need to take a look at your overall tax strategy. Okay. But if you're doing business in the state of California, you have to bite the bullet and go ahead and pay. Don't believe this crap about, oh, I can have a Wyoming LLC and only pay there and I can do business in California. You let the state of California find out you're doing that, especially if you're a California resident.
All right. Hey, we got Joni in here. She says, hey, Bill.
Joni.
Yeah, good to see you here with us this morning, Joni. Okay, guys, if you got any questions, we're only going to be on a few more minutes, and I know Bill's got a couple more tips for you. So what's our next tip for saving money?
Let's see. I'm kind of going through some of these. Oh, pay your family members. Okay, pay your family members. All right. And this is something, guys, that you can kind of reconstruct on the 2022 side, have it still apply for 2021. You should be paying your kids. Listen, teenage kids are expensive. Trust me, I had 3 of them. Okay. You're always spending out money on your kids. You're giving them money for ball games. You're giving them money for movies. When they get older, you're giving them money for gas in the car. Okay. pay them so that you get a deduction for the pay and let them buy their own stuff, let them pay for their own games, let them pay for their own $150 tennis shoes, right? You can write that amount off. Your children can make up to $12,500 and not pay any taxes. Now, there's a couple ways to do it. If they're over the age of 18, okay, if they're 18 or older, you will probably have to give them a 1099 or a W-2 if you're running payroll. Okay, if they are minors, 17 and under, you don't even have to give them up a 1099 or a paycheck just because they're your children. You can't do this for all children you hire. They have to be your children that you hire. Okay. Right. But this is a great write-off. And since it's active income, you can have them fund a Roth IRA with some of that money.
Imagine, okay? So imagine having a Roth set up for you, Bill, when you were 10 or 15 years old.
Do what?
Imagine having a Roth that was set up when you were 10 or 15 years old.
Oh my gosh. Even if you only made the one $6,000 contribution and let it sit there, do you know how much that $6,000 could be worth when you're 65 years old?
Yeah.
Okay. So pay your kids. You can also pay your spouse. You can hire your spouse. Now, this is most effective if you have a retirement type program. Right. So if you are self-employed and you got a solo 401k or something like that, you always want to put your spouse on payroll, pay them at least the amount of money that they can max out their retirement savings. And you get a tax deduction for it, or the company gets a tax deduction for it. So family should be paid. There are a lot of different structures that you can do that. But if you've got family, you're not paying them out of your company now, you ought to consider doing that. Okay.
Okay. Let's see. Can you use a series LLC for multiple holding entities for long-term holds?
Sure you can. If you're in a state that recognizes series LLCs.
Okay. Should I hold my personal home in a living trust or a land trust?
You should not hold your home in a land trust. Okay. I don't have a problem with your home being in a living trust because that's for estate planning, right? And you're wanting to avoid probate. You still have to be careful how you put it in there, but I have a lot of clients who will put their personal residence into a living trust, not the typical land trust that we're talking about, okay? I would not hold a personal residence in that type of trust, but in a living trust that is set up for estate planning purposes, absolutely, it could.
Okay. Michelle asked, if a trust owns a property, are they responsible for sending out 1099s?
Why would you send out a 1099?
Yeah. Tell us more about that, Michelle.
Yeah, give me a little more information, Michelle, on that. And I'm wondering if you're talking about like being a landlord or something like that. Very few landlords right now have to send out 1099 forms.
Okay.
So give me a little clarity, give me a little clarification on that, and my answer might be different, but ordinarily I would say that you don't need to send out 1099s.
Okay. Did Biden hire more IRS auditors as he wanted to?
Well, probably. I know they have hired more. Okay. They've already started hiring more. I know that the Build Back Better bill was supposed to allocate funds for that. And guys, I will tell you, if you don't believe they're coming after real estate investors and small business owners, it's not just the people who make $400,000 or more.
Yep.
But no, that has not passed yet. The bill has not passed yet. They have started hiring people, but the bill has not passed yet that will allocate funds for it.
Okay. Vincent says, I just set up a Wyoming LLC. Should I make that the holding company for my California LLC?
You absolutely could. I love holding companies. All right. That, however, is not going to keep you from having to register that California company in California and pay the $800. But I think you know that. What you would need to do is, if you set the California company up in your own name, you need to transfer the membership interest to the Wyoming LLC and make the Wyoming LLC the sole member of your California LLC.
Okay. He's got a follow-up question here. Can I have a series LLC in California?
I'm not sure if California recognizes series LLCs or not, right off the top of my head.
Okay.
If California does recognize series LLCs, then yeah, you can set up the same thing that someone else asked about. But I don't remember off the top of my head if they allow it. Not every state does, which is why I don't know.
Okay. Cindy said, have y'all talked about HSAs and solo 401ks before, maybe in the vault? I think we did.
We'll probably do a podcast on 401ks.
Okay.
Okay.
Cindy, we may have covered that in that, 2-hour session Bill did a couple of months ago. I would check that out.
Yeah, I think we did talk about it briefly. And
Right.
Cindy, I'm glad you brought up HSAs because that was going to be my next tip. Okay. Everybody ought to have an HSA if they qualify. Okay. Everyone should have an HSA if they qualify. Here's why. You can use an HSA in two ways. You can either put the money in the HSA, take it right out and pay for qualified medical expenses. And if you're paying qualified medical expenses, withdrawals from an HSA are not taxable. Okay. Incidentally, if you are a single individual, you can put $3,600 into an HSA for 2021. If you are family or have a family, then it's $7,200. That's tax deductible, just like the old IRAs were. Okay. So you get a tax break for that. If you take money out of the HSA, if you're under 59 and a half, okay, if it's for qualified medical expenses, there are no penalties. You can just pull it out tax free. If you are under 59 and a half and you pull money out of an HSA, if it's not for qualified medical expense, there are penalties and ordinary income taxes that have to be paid on it. Okay. Now, you can put money into the HSA, you can pull the money out of the HSA and for qualified medical expenses, or you can do like I suggest to my clients. If you've got the money, pay for your doctors and your sniffle stuff and your prescriptions out of your pocket. Put the money put the $7,200 or the $3,600 into the HSA and leave it there because you can invest that money just like you can with an IRA. Okay. Now, the nice thing about it is that there is no time limit on the reimbursements. So I've got one client, he's in his 30s. He said, Bill, I'm going to put that money, that $7,200 in because I have a family. I'm going to put the $7,200 in. I'm going to get the tax break and I'm just going to invest the money. And when I start taking that money out when I retire, he said, I'm going to go back and reimburse myself for those expenses, those medical expenses from 30 years ago. And you can do that as long as you have the expenses. So any expenses he pays during that 30-year period up until his time of retirement, if he's got the receipt for it, he can reimburse himself for all those expenses, and the money he takes out is entirely tax-free. Once he runs out of receipts, then the money will be taxed at ordinary income rates, just like distributions from a IRA account. Okay. HSAs are wonderful. Everybody ought to have one if you qualify.
Yeah. All right, guys, listen, we got to wrap this thing up. Bill's got to get out of here. You know, he's giving away 6 of these tax sessions. So if you ask a question, you're entered into a chance to win. You need to send Bill an email at bill@billwalston.com. And subject line should be, Bill, what are you
I'm
looking
in.
for?
Give me a session. Anything. Okay. Just get me an email to that. And I'm going to go back and get with Jody and say, here are the people who sent me a request for a strategy session. How many of these people actually participated?
Yep.
In the call?
Yeah. So good luck to all of y'all. We hope that you're a winner. But we're all a winner. We got to listen to Bill this morning talk about taxes.
That's right. Taxes are fun.
Yeah, they're a lot of fun, aren't they? All right, guys.
Thanks for having me, buddy. I really appreciate it. I hate to have to run, but we're going to do another one of these.
Yeah, we are. Okay, guys, that's it for today. Listen, we appreciate you showing up for Goat Talk every Thursday. We do this every Thursday morning. Subscribe to our YouTube channel and you'll get notifications about these. So in case you get busy or forget anything. But all right, we're going to get out of here. We will see you next week. We appreciate everybody that joins. Appreciated Bill for coming on today.
My pleasure.
All right. We'll catch y'all next Thursday.